Hey, what's going on, everyone? Last week, I introduced a few stories that could have a major effect on the future of the market. And this week, I'm going to update you on the biggest changes since and the new factor the Fed revealed they are concerned about in their biannual financial stability report. That's coming up right now. Welcome back, everyone. I'm Rick Harrison with MVP Realty. And in today's Southwest Florida's housing market update for November 22nd, 2021, I'm going to take you through the local market changes, some 2022 interest rate predictions according to some major players, and the biggest events that took place this week shaping the future of our markets. Oh, and if you haven't already done so, make sure to subscribe and click the bell to get notified of the latest videos each week showing you everything you need to know about living, buying, and selling your first home in Southwest Florida. All right, so let's dive on in. All right, so coming up today, we got the local market analysis. We'll see what's changed in our Southwest Florida region as far as the market conditions. We'll also take a look at the interest rate predictions from some big players in the mortgage industry, what their predictions are going to be for 2022 interest rates, and then the market news over on the right-hand side of the board. The big announcement is a social spending bill that passed. That was a $1.75 trillion bill. We also have another $1 to $2 trillion of bills sitting on the table, waiting to be voted on and passed along. We're also going to be listening to Peter Schiff's breakdown of the current economy. If you don't know who Peter Schiff is, he is a financial analyst and he's also a manager of assets for many investors. He did help predict the 2008 bubble, as I said, but we're going to be looking at where he feels the economy is today, how we got here, and then where the markets are heading in the future. And as far as that goes, what the Feds have for potential ways to curb the inflation. And then lastly, we're going to just take a real brief preview of the Fed's financial stability report and some of the things that they are making themselves aware of. They were obviously already aware of the inflation issue, but they were downplaying it. I think this report actually lays it out a little bit more clear that they are aware of the current situation and they are actually looking at some potential catalysts. If anything was to happen with the economy, what those catalysts might be. They have identified several that they're going to be keeping an eye on, and I think it's important for all of us to be keeping an eye on as well, so we know what's heading down the pike for that. So now we got the 7-day market update. Some interesting developments over the last 7 days. As you can see, these solds went from 653 last week to 873 this week, which is up quite a bit. These solds are up 33%. And then as far as what the other key indicators of the new listings, those are down 13%. I think we were kind of expecting that right now we saw last several weeks that the extensions have been down, and that's again down 11% today, and then the pendings are up 3%. The interesting story here is the solds going from 653 to 873. That means that 220 of those pendings from last week went on as solds this week, which means that the pendings actually increased by 257 new listings pending under contract. So what we're seeing here is the listings are going down again and the pendings are increasing. So more homes are coming off the market than new listings going on. We're supposed to be seeing some changes as far as more listings coming on, if not in this winter, but definitely by spring. As anybody who's been listening to me knows, I don't know what's going to happen in 6 months, but I'm willing to bet the interest rates are going to be on the rise not too soon after the new year happens. So going into the interest rates, the updated interest rates, NerdWallet has their interest rate going from 3.011% last week to 2.952% this week. Again, bank rate is the exact opposite. They're going from 3.15% to 3.2%. Again, NerdWallet pulls their data from Zillow. Bank rate is more of a banker's industry stats. That's where they usually get their stats from. So what does that mean for everybody? I mean, we've been seeing this kind of play out over the last couple months, really, the interest rates have been staying around 3.0% throughout, just because I think at this point it's really just inflation. The Feds really they can't really do a whole lot. They've already set out their timeline to taper bond purchases. And in turn, when that ends, when they're back to a zero set, they'll be able to begin to raise interest rates. So what were the interest rate predictions? Fannie Mae is coming out with a 3.4% by the end of 2022. Freddie Mac is at 3.5%, and then Mortgage Bankers Association is at 4.0%, which is the highest one we've seen. And you also have Redfin at 3.6%. This is all from a Market Watch post. You can get the link in the description to read the full article. But as far as these interest rates, what is that going to be? I think we're starting to look more and more now like it's going to be 2 rate hikes in 2022. So I'm tending to agree with Mortgage Bankers Association, looking at a 4%. But you never know. We really have to see how the Feds handle the inflation issues right now. And then as far as the housing predictions, what's going to be happening in 2022, if everything stays on quota the way it is right now, you're going to see less competition. That's simply because the interest rates do have to go up at some point in time, I believe, to help curb the inflation rates a bit. But at the same time, the competition might be lower. The barrier to entry is going to be the inventory. Can you find what you're looking for? And then the price, can you pay it? It is still going to be high, while the predictions are that the market will correct to some extent, lower the revenue or the growth, the home value growth. Um, they're looking at the very least at going to 3%, maybe more. But that's still an increase from where we're at. They're not predicting that the prices are going to be going down. So that is going to slow down the market a bit. So, and that's already started. Inventory is up overall for the 4th quarter in a row, but we see more sellers starting to cut their prices and the days on market starting to increase. So, with that, the announcement that we had that I said in the beginning was that the current debt, or the social spending bill, did go through for 1.75 trillion. Those numbers, I mean, I've been hearing 1.2, 1.75. Either way, it's in the $1 trillion. So that brought a current to $28.98 trillion debt, where we were currently at just a week ago. That's going to be putting us up over 30, and then we still have another $1 or $2 trillion worth of bills that are in the pipeline to be passed. So that would be more money printed out to accomplish those as well. So if you can't remember, back before the pandemic started, we were at about $23 trillion in debt. So we are well over the $7 trillion in the last 2 years that we've printed, and we have another $2 trillion on top of that coming down the line. So we're going to take a look at the financial stability report and what it included in the market report, what the indicators were, what they're looking at, what the Fed actually knows about the economy right now, and then what they're predicting for potential catalysts that they're going to keep an eye on to make sure that they can stay ahead of anything should it develop. And we're going to take a look and listen to what those potential catalysts are right here.
Easy to predict what the event might cause a crash that leads to that bubble popping. The Fed is clearly aware that this bubble exists. They are just having to be a little bit more diplomatic than I am when discussing it, but they also have the unfortunate risk of predicting what might cause this crash, and that is a very difficult thing to do. Nonetheless, they have given it a shot, and unsurprisingly for regular viewers of the channel, they believe that the most likely catalyst for a crash is the Chinese real estate sector. Now, for anyone who isn't 100% clued up on what's going on, the Chinese real estate sector is hanging in the balance, and it could be about to collapse at any moment now. Over this past year, property developers started to seem like they weren't going to be able to pay off their debts, as the Chinese government had put on restrictions on the amount of leverage, debt and bonds they could take out. These developers relied on this debt to fund their real estate projects, and without influxes of cash, it quickly became clear that they weren't going to be able to complete them. They weren't going to be able to generate revenues or profits to pay off their debts either. Chinese developers' bond prices dropped off a cliff as investors suddenly realized they probably weren't going to get paid. right as problems started to emerge with Evergrande, the second largest property developer in the world. Evergrande missed a debt payment, then they missed another and another, and while so far they have managed to stave off from officially defaulting, there is really no way out for them, and it's only a matter of time.
So there you have it. I think that did a pretty decent job of summing up, a couple of the catalysts, and the major one being obviously Evergrande. That's something that everybody's been keeping an eye out on. That's including financial analysts from the markets as well as the housing market, Wall Street. They're all looking out at what could potentially happen to Evergrande and how that could affect our economy. All right, and so right here we're going to take a look at Peter Schiff's his take on the state of our economy, how we got here, kind of what the potential uh, outcomes are, and what their moves are for the Feds if they have any left.
Note on Sunday, Goldman Sachs actually warned inflation will get worse before it gets better as we continue to see supply issues coupled with rising energy prices. Do you consider that a valid claim, considered these latest numbers?
Well, I think they're half right. I think it's going to get worse before it gets much worse.
Please elaborate, Peter.
Well, I mean, the inflation pipeline is pretty full. In fact, if you look at the PPI numbers that came out today, in the first 10 months of the year, producer prices are up 8.3%. Annualize that for the full year, and that's 10% increase, which is quite a bit larger, I think. Consumer prices are up maybe about 6% during the same time period. So that means companies are absorbing a lot of the price increases, and I think they've been reluctant to pass them on because they've been hoping that the Fed was right and that the inflation is transitory. But I think as they realize that the Fed was wrong and that inflation is here to stay, not only are they going to be passing on the rate or the price increases next year, but they're going to pass on this year's increases that they have been holding off on. So I think we're going to get a double barrel in 2022, which means that consumer prices are going to move up a lot more next year than they did this year.
And Peter, it seems like the goalposts keep getting moved when it comes to the transitory inflation relief, if you will. The Fed obviously took steps last week to roll back some of its QE and other easy monetary policy, but will that really have any effect on the pressures that we're feeling now, or is that all too little too late?
Well, first of all, they're still doing quantitative easing, even if they're doing slightly less of it. And of course, this is just temporary. They're going to back up the truck and do even more QE because they just passed the $1.2 trillion infrastructure bill. You've got another one that's even larger, Build Back Better, whatever they're calling it. That one is going to pass. So where's all the money going to come from to pay for all this government spending? They're not getting it from higher taxes, so they're going to get it all from the Fed. And the Fed is going to have to expand its asset purchase program to buy up all these bonds that are going to be sold to finance all this spending.
All right, so I think as you can hear from what Peter Schiff had to say, I think he does a really good job of summarizing kind of the state of our economy, as least as an analyst sees it and as an investor sees it from his perspective, where he feels the market is and what he sees happening in the future. And like I said, I'm not all doom and gloom. I think these are just different perspectives that people need to be aware of to make the best decision, moving forward. So just take this as one perspective, and then you can also listen to the other several sources. But this is something just to keep an eye on, so you're aware of what's going on in the economy and how that might affect your decisions moving forward. So, what are the key events to keep an eye on? What are the indicators we're looking at? So, obviously, how the Feds adjust the bond spending, the bond tapering, as well as the interest rates eventually. The other, obviously big catalyst that we're looking at and keeping an eye on is Evergrande and China's just economy in general, with how large it is and how intertwined it is with many of the other economies in the world. A couple interesting things you might want to check out yourself. Bezos, Musk, and Branson, they've been selling off or have been, I guess, spotted selling off their companies, their positions in their companies. So this is another thing that people are speculating about, whether they know something's coming and they're trying to get out of their stocks because they feel like they're overvalued right now. That's just something you might want to check out and look into. And then obviously market, is the market following suit? Because I know a lot of investors look at those three guys as some of the top investors and top minds in investing, and just understanding the economy and the way things work. If they're doing that, then you're starting to see a lot of other investors follow suit, just because they are touted as kind of being able to, understand the market so well. So those are the indicators for the for this week's segment of the market update. And then the sources that I've got this from: Market Watch, US Debt Clock. If anybody's never used US Debt Clock, check it out. usdebtclock.org /# That it's just a clock that shows you all the information of what's going on, what we're taking in as assets, and what our liabilities are as a country. And it's interesting to see the numbers. And it does have a lot of good information. If you hover over a specific number, it'll tell you what that number means and how it's used and forecasted. So then you also have the 3 YouTube videos here. I'll have all these links in my description for those of you listening. You'll be able to find it in the description as well. But those different clips, and there's also the PDF report of the stability report if you want to read the 80 pages. It's a little bit dry, and then there's some extra clips in here to check out about this information. Well, that's this week's housing market update, and I know I threw a lot at you, but if you have any questions, you can leave a comment, give me a call, or shoot me an email at rick@swflrelocationteam.com. If you found this video helpful, please hit that thumbs up button to let me know. And don't forget to subscribe and click the bell for more videos helping you navigate our Southwest Florida market. Thanks so much for watching, and I'll see you next week.